Principles of Accounting, Chapter 5. In Chapter 5, we are going to discuss costing inventory. So in Chapter 4, we talked about buying and selling inventory, and now we're going to talk about how businesses record the cost of inventory when they buy inventory at different price points. So inventory is anything that we've purchased to sell to someone else. So we have goods in transit, goods on consignment, and then goods damaged or obsolete are some things that we're going to talk about. Goods in transit are either FOB shipping point or FOB destination. FOB standing for freight on board. So if it's shipping point, then we include the goods in our inventory when shipped. We take possession at the time they are shipped. If it's destination, then the buyer doesn't take possession until the inventory is placed in their care or their possession. So then we don't include that in the inventory until it arrives at the destination. If we sell goods on consignment, then the consignor is the owner of goods, and we are selling the goods for the owner. We never report the consigned goods in inventory. We might take a percentage of their sales as part of our commission for providing the selling services, but the merchandise is part of the inventory of the consignor and isn't part of the inventory for the consignee. Then we have damaged or obsolete goods. We don't report things in our inventory if they cannot be sold. Anything that can be sold is included in our inventory at its net realizable value. The net realizable value is our sales price minus our selling costs. Then we record a loss when the damage or the obsolescence occurs. So if we have to get rid of inventory because it has been damaged or spoiled in some way, we would record a loss for our inventory. The same thing as if it is obsolete and we can no longer sell it, even if it's in good condition, but the technology is so obsolete that we cannot sell that inventory, or it's well past a sell-by date, then we would also record a loss for the disposal of that inventory. When we're determining what our full inventory costs are, we can include any expenditures necessary to bring an item to its sellable condition and its location. So we can include the full cost of inventory, shipping, storage, insurance, and any import duties we might have to pay if we're buying things internationally. When we have inventory, we need to maintain good internal controls. We also want to take a physical count at least once each year of our inventory to make sure that our physical count matches up with the merchandise inventory that we have on hand. If the physical count does not match up, then we need to record an adjusting entry to reduce our inventory to the amount that we actually have on hand. So good internal controls for to make sure that we don't have a loss of inventory from theft would be inventory tickets, barcodes, making sure that whoever is counting the inventory is not responsible for maintaining and reporting the inventory, making sure that our counters confirm the existence, the amount, and the condition of all inventory we have on hand. So we don't want people who are having their performance evaluated on inventory to be the ones counting the inventory, and we want the counters to verify that this inventory actually exists. We also want to confirm that all items have only been counted once. We have 4 methods for costing inventory. These 4 methods are specific identification, first in, first out, or FIFO, last in, first out, or LIFO, and weighted average. you can see on this pie chart here that FIFO is the most common inventory costing method. LIFO and weighted average are also used, and specific identification is in the other. When we're looking at these different methods to assign costs to inventory, with the first in, first out, we're recording the first costs as being the first ones that leave the door. Last in, first out, it's our last number of costs. For weighted average, we take an average of all of the costs accumulated across our inventory. And with specific identification, we have unique inventory that we know exactly how much it costs. So there's no last in, first out or anything that we need to aware of it. Specific identification usually occurs in industries where we have very unique products, such as the jewelry industry, are more likely to use the specific identification. When we're looking at these inventory cost flows, first in, first out cost flows happen in the order in which they occur. So we have merchandise on May 1st, merchandise purchase on May 3rd, and merchandise purchase on May 6th. All three of those purchases were different amounts. When we sell a cost of goods sold, the first thing that we purchased, or the first cost, is going to go out. The last in, first out is exactly the opposite of that. We're going to record cost flows in the reverse order of which they incurred. And with the weighted average, we average all of those costs together, as you can see here. We have three different costs for inventory. We add them all together, divide by the fact that we have three of them, and then put an average cost on all of them. Our inventory costing does not mean that's the physical flow of our inventory. So physical flow and cost flow are not the same. So when we say we use a last in, first out costing flow, that doesn't mean that we use that for our inventory. Most physical flow of inventory, except with the specific identification where we have unique items, follows the first in, first out method, whether or not we use that cost flow or not. When we're looking at the inventory effects and our costing effects, what our costing method decides is how much our inventory is on our balance sheet and how much we record in costs of goods sold. So if we're looking at this example, we can see an inventory sheet. We have beginning inventory on August 1st of 10 units. We recorded at $91 each. We have a mountain bike inventory for a biking company. We then purchased 15 additional bikes that cost $106 to purchase. Then we sold 20 of those bikes at $130, leaving us 5 units. We then purchased 20 more bikes, taking us up to 25 units, purchased another 10 additional bikes, taking us up to 35 total units, and then sold 23rd bikes, taking us down to 12 units left. So as we look at this sheet, we see all total, we had 55 units available for sale throughout the month of August. We sold 43 units and have 12 units left in stock. So how we record the cost of goods sold determines on which method we're using for inventory costing. So first we're going to look at specific identification. When we look at specific identification, we know that we sold 8 of the bikes that we paid $91 for, and 12 of the bikes we paid $106 for. Then on August 30th, we have a recording of the bikes that we sold. We sold 23 additional bikes. Of those 23 bikes, 2 of them were the $91 cost, 3 were the $106 cost, 15 at $115, and 3 at $119. Therefore, we have a total cost of goods sold of $4,582, leaving us with ending inventory of $1,408.